The CRA wanted proof that he moved in and moved out. We said to them that he moved in with his family members. They wanted evidence of a moving company.
Hey investors, Bradley here from Watson Estates, and you're listening to the largest, fastest growing podcast for Toronto real estate on iTunes, Spotify, and Google Podcasts. Now, the reason that our channel is growing so fast is one, because you hit that subscribe button, and two, we have fantastic guests. Think of the spending that's been coming out of all levels of government these days, and just wonder, how are we going to pay for that? Is it going to be changes to your income tax? Maybe changes to the capital gains tax? Or how about, what about this? The complete removal of a primary residence exemption. All of these things are still up in the air and being debated at a very high level. And I thought this was a fantastic time to have my good friend Leo, back from university days, come join us on the podcast. He works as an accountant, and they specialize in business accounting and taxation at HS Partners, a great organization that I've partnered with for a long time now. And he's also such a nice guy. He told me after we were done shooting this podcast, if you guys have any questions as you're listening and there's something that's kind of like, well, what about this? Feel free to put that in the comments down below, and they're going to monitor our video. They're going to keep an eye on it, and they want to make sure that you guys as investors have the right answers and the right resources in front of you. Enjoy the show. Hey, Leo, how you doing?
I'm doing good, Brad. How are you?
I'm doing good. Thank you for taking time to come and say hi over the weekend and talk to some of our investors about the wonderful and exciting world of tax.
Thank you for having me. I'm looking forward to this.
Now, for those of the listeners out there that don't know, I once had a dream of getting into the world of accounting. And so you and I have met since university days, which is more than 5 years ago. We'll stay with that.
Yeah, more than that.
More than that. And so right before we started recording, you were about to tell me a little story about how the last time you saw me in the world of accounting. Maybe you can share with our listeners a little bit about that.
Yeah, I believe it was second year. Could have been third.
I think it was third.
And it was intermediate accounting. And I was all excited for the class. I heard the teacher was a strict one. And me and Brad had been friends prior to this. And we sat next to each other. Brad seemed pretty excited. And that ended next week. Brad doesn't show up, taking attendance. And they're like, Brad Watson. And I'm like, sir, I'm pretty sure he's coming. And he says, nah. He says, a lot of people drop out of my class. It's one of the stricter ones. I said, I don't know, not Brad. Brad's not a quitter. And and yeah, he let me down. I saw him in the hallway and he said, yeah, the accounting's not for me.
Yep. So, and from that time on, I was going to run into a finance and then come to realize I didn't need to do that either. And now I'm in the world of investing in real estate. So, but all the way through, we've maintained relationships, and you've gone ahead and you told me you got your CA and now CPA. And so we've been able to maintain a really good friendship through these years and have, whether it's in a Tim Hortons parking lot or whatever, or on a Zoom call, we've been able to stay in touch. So this has been great. And I encourage everyone who's listening, if you don't already have a super tight relationship with the people around you, right? Property managers, accountants, lawyers, inspectors, whatever it is to get those deals done, make sure that you do. So let's start with a nice little underhand pitch here to get the conversation started. Why don't we talk a little bit? I get a lot of questions about how to structure a deal. At what point does it make sense to either buy an investment property in your name or jump over and maybe create a corporation?
Well, first I want to mention that it is definitely important to have a team. I've had many clients over the couple of years that have come to me and, they say, here's what we've done. And now we got to retroactively plan to make it happen. And then they come to the same conclusion every time. Man, I should have phoned you first. So yeah, I couldn't agree with you more that tax planning is part of the big three: business, legal, tax. Tax does come last, and business and legal are more important, but it's all a group. So coming back to owning it, corporate versus personal. So this is the most popular question. And we always recommend to do in a corporation, and strictly that's to do with asset protection. Because insurance companies are notorious for trying not to pay. They will do whatever they can in their power to argue there was negligence in some way. And typically insurance is only $1 to $2 million, depending on the policy. And if something catastrophic happens, which is rare, it can easily be more than $1 to $2 million. While it's in a corporation, we can protect your family, your spouse, and your children. And we can protect an operating business. Sometimes, typically, people who are buying rental properties, 1, 2, 3, have an operating company that they want to protect. And there's ways to work through the income side of a passive investment in a corporation that it still makes sense to achieve the asset protection and the small amount of compliance fees to run it, especially in the first couple of years.
Right.
Versus in personal, one can say that it's easier because the compliance side is once a year. There's no ongoing accounting. There's no corporate tax return. There's no dividend strategy, salary strategy, anything like that. So typically what we see is, investors will buy the first, second, maybe the third personally, and then start to realize that corporation is the way to go. And if you have an operating company, then for sure corporate is the way to go because you can use corporate tax money to buy the property instead of personal tax dollars, which is much more beneficial.
And what are some familiar structures that you've seen?
Well, it depends on the situation, but if it's a single person buying a rental property, then they will incorporate sister companies. And when I say sister companies, one corporation per house or property, not parent, sub, where it's going down a chain, it's always sideways. And that is because you want to keep asset protection going sideways. Other ideas are if you're investing with multiple people, if you could open up a general partner and a limited partner to run it, but that only makes sense when there's some scale and the numbers are bigger. So typically you have one shareholder own it and sister companies across.
Interesting. Okay. So let's jump back a little bit because for people who aren't familiar with corporation, I think I don't want to dive too deep into corporations because I want this conversation to be applicable to a lot more people. So before we start jumping into your properties and all that, how do you think income taxes, or what are some of the things coming down the pipes you think could happen? I mean, we've seen what are we at now? $1 trillion in total debt. I think it's a third of $1 trillion. I don't know. The numbers are outrageous that we're seeing of spending. And obviously there's a conversation on how can we recuperate those and pay off these deficits, or at least pretend to pay off some of these deficits. Yeah. What are some of the income tax changes you guys are seeing, or some of the whispers on the street?
Yeah. So COVID spending, you can see it, you can't miss it. It is large. And the government has now recently just said in their throne speech that they're looking at taxing the wealthy. This is no change from Trudeau and the Liberals coming in from before, when he always said the rich should pay a little bit more. So what educated people and articles are writing is to go after inclusion rates of capital gains and principal residence exemption. Why would you go after these two things? Well, because they're low-hanging fruit. If the government changes, a inclusion rate from 50 to 75, now they just generate X amount more dollars, and capital gains affects a lot more of the population. This is kind of the downside because they say they want to attack the 1%, but usually what happens is the middle class get attacked the most. So the low-hanging fruit is definitely the principal residence exemption and the inclusion rates. And talking a little bit about inclusion rates, you may think, oh, no, they'll never change it. Well, no, it wasn't that long ago that it was only 75%. In the 90s, it was 75% inclusion rate, which got changed in the early 2000s. So it is definitely possible. Talking about principal residence, it is on their radar already. In 2016, there was a new regime change that you had to report it on your personal tax return. Whereas before, it was kind of, the Wild West. You didn't have to report it. People were buying it in their sons' names, daughters' names, cousins' names, you name it, to, multiply the principal residence exemption. So these are the two areas that we think are the most prevalent for discussion.
Now, where I think people would get freaked out, and when I listen to other people talking about this potential, is, well, if I've got a portfolio of 20 properties, and right now I'm being taxed at 50%, why wait until next year and risk being taxed at 75%? What would you have to say to people in that camp?
Okay, that's a great question. We would expect, similar to how they did in the past, that the government would not just change it right away. There would be some lead up time. We don't know how much. Typically, it's 8 months to 2 years. And what they would allow you to do, we would hope, as they've done in the past, is evaluation, which would allow you to lock in the rate at that time and historically allow you to go at the old inclusion rate. And only the increase in tax would be subject to the additional inclusion rate. Now, linking back more to the real estate market, there's talks that, if the inclusion rate change, we're going to sell our property before that happens. I'm sure there will, in my opinion, I'm sure there will be a percentage of this happening. I'm not sure how much it'll be, but it's definitely a planning idea. And around that, which I'm sure your viewers all know, is you want to make sure you keep as much receipts as you can, all your receipts, because you want to be able to increase your adjusted cost base to limit your gain. And around, if you have 20 properties, you definitely have to be thinking, what is your horizon? You want to keep these for longer? Are you thinking about selling them off? If you're that already in your plans, maybe you accelerate your plan.
Right. Okay, we're gonna jump into primary residence exemptions in a second, but before we go there, just to toss you another hot potato, do you think? Because I've had a lot of people argue that CERB is going to be needing to be repaid, and obviously there's no ground to say it will or it won't. What's your thoughts on people will need to pay back CERB? What do you think that's going to look like? Because I'm already seeing articles, I'm sure our audience is too, of this amount of CERB has already been collected back. So what is that going to kind of look like moving forward?
Well, as you said, it's difficult exactly to say. However, I believe with CERB, it can go one or two ways or in the middle. I believe there's a route that they write it all off and they don't investigate CERB. As you've heard in the news already, there's a lot of fraudulent claims and the government hasn't really acted on those. They've kind of just turned a blind eye. Right. So there's the camp of writing it all off versus, let's inquire and audit these people or do a limited review, which would entail something to the effect of a letter saying, document the criteria that you met in order to repay it. I'm more in the camp that they are going to write it off. My reasoning behind that is because they have other programs to go after, such as the wage subsidy and stuff like that, that is more lucrative and they can more sink their teeth into it. Gotcha. And a repayment of CERB, I believe it'll come in other ways. Tax increases, as we talked about, inclusion rate change, other things that they could easily tweak to try to increase their coffers.
Yeah. All right. So the primary residence exemption has been kind of a big play for a lot of people. It's really your starting level. Some people see it as, it's a benefit to your first home, and that's kind of been the design. But many investors that start early, younger investors, recognize it's a huge tax advantage, a huge tax planning tool. Now, also, we're starting to notice out west, there's different studies, there's money's going in and the government saying, no, we won't do it. But yet you mentioned earlier in the podcast, we've got people having to report now where they live, which is completely unusual unless you planned on doing something with that information. So do you anticipate, or do you guys think there's a potential, without knowing for sure, do you think there's in the realm of possibility we could see a primary residence exemption removed or changed? And what could that look like?
In our opinion, we don't see it being removed, as it's not in the government's mandate to affect the middle class, because principal residence affects everybody.
Right.
We do believe that there will be an increased presence of reviewing the principal residence exemption claim. As you mentioned, why are they taking this data? Well, because the increase in housing across, BC and Ontario has been significant. Therefore, the tax would be significant. And it's low-hanging fruit, and we've seen it happen already with our clients. The government will send you a 9-page questionnaire, which doesn't seem very invasive, but the questions are all looking towards your intent. because with principal residence exemption, you need to be able to demonstrate that you purchased it to live in it, not to sell it in the future for a profit, which is very difficult for CRA to substantiate. However, they will take very small pieces and come to an assumption that it was speculation. For example, we had a client that sold the property, claimed principal residence exemption. It got reviewed. He had owned it for 2 years. The CRA wanted proof that he moved in and moved out. Well, we said to them that he moved in with his family members. They wanted evidence of a moving company to show the furniture being moved in and out. Well, that didn't exist.
Interesting.
And we had another one where they wanted you to explain why you bought it. Well, we told them it was because we bought it to live in it. It was a pre-construction condo. And they just said, well, you have knowledge in the business and we're claiming that it's speculation because you have your master's of business, which is incredible because it's not even like a real estate agent. You might be able to argue that a real estate agent was buying on speculation 100% of the time because they're in the industry. They are making leaps that they never used to make in the past in order to try to justify that principal residence exemption does not apply. Now I can talk more about how some of the tips and traps of principal residence exemption. And we've said it to clients before, if they're going to be in there short term, make sure you have some documentation. Christmas dinner, Thanksgiving is coming up. Have some photos of you and your family there serving dinner. We know it sounds crazy, but these little things do help support your case. Another big one around principal residence exemption is if you're renting a portion of it. You want to ensure that that portion of your rental represents a small amount. Now, small is not defined. However, in our opinion, it's not 50%. It's less than 50%. So you want to be able to support that the basement is a small portion of the home in order to still make the claim. And as your viewers know, there's something called CCA, which is depreciation of the property. We never claim depreciation on a property that could be a principal residence in the future, maybe if you move in or your daughter moves in, or if it is your current place. Because once you claim depreciation, your principal residence exemption is out the window. And just to elaborate a little bit more on depreciation, it's only a deferral of tax. It's not an ultimate savings of tax because in theory, the property should increase by the time you sell it. And there's something called recapture and you have to pay it all back.
I'm just trying to think here. You got a lot of gears turning in my head as you're talking there. So now how long, so there's no real, what you're saying is there's no real time frame for like in stone. It's just, it was intended to be a primary residence. And this is interesting for investors too, because there's really two sides of the coin. This accounting side is one part of this and whether you're going to claim the primary residence exemption. The other side is with the lender, which we're not going to get to here, but the lender obviously you can get something with less than 20% down should you be moving into that property. So some people will just see that as an opportunity. Where does the first-time home buyer rebates kick in? Does that kick in the line of the CRA or does that kick in some other level that even if this got audited and reviewed, would that come back on them or no?
Well, around the HS, I believe you're talking about the HST rebate. And yeah, with the HST rebate, there's two types. There's when you're principal residence or it's when it's a rental property. And we have seen it before where buyers will go and they'll say it's their principal residence to the lender and even the builder because sometimes they assign it to the builder. But you can see it coming back on that. We have had an HST rebate review and CRA was trying to demonstrate that it was a speculation buy. And the taxpayer can be out of luck there because if they don't have a tenant, they don't qualify for the rental side of it either. On the same token, we have people where they've went for principal residence claim for the HST rebate. It gets reviewed, but they have a tenant. So we have seen CRA flip it to the tenant side and say, okay, you're not eligible for on this side, but you're all eligible on this side. So they can work with you. It's when they can try to demonstrate that there's speculation. Now, one thing to talk about too is a series of buys and sells. And I'm sure you have friends and people listening that, they get married or they're dating or whatever. They buy a house, they improve it, they sell it, they buy another house. They improve it, they sell it, they buy another house. They improve it, they sell it, buy another house. And they flip this house every 1 to 2 years. CRA has made the claim that you are in the business of improving houses and the principal residence exemption should not apply. Even though in that scenario, you are fully living in it. You have documentation to show your kids are there, that you have an internet bill, you have a cell phone bill, you have cable there. You can demonstrate a moving company. And CRA will still say, nope, you have knowledge of the business because you're a contractor and we see this as a series of buys and sells. And that is difficult to get out of, especially if you're in the industry. So talking about timelines, it depends in every circumstance. In that circumstance, you may not be able to demonstrate it unless you can show that you're here for 3 years, or you need a bigger home because your family is expanding. You need something to substantiate it. And linking back to the change in 2016, they have the documents because when you do the report, you have to say, when did you buy it? So in my opinion, it's very easy for CRA to say, okay, have the computer kick out a list that says, here's all the taxpayers that sold something in 2020 that only owned it for 2 years or less. All right, computer, send out a questionnaire to everyone that's on that list. And out of that questionnaire, 50% of those may not reply. You get a second letter, and it just creates a pool. Computers have gotten a lot stronger with CRA. In my 8 years of practicing, what CRA could do in year one versus now is mind-boggling. And they're only getting better because the more they invest in computers, the more tax dollars they can generate. And you see it all the time with Trudeau. When Trudeau came in, he gave, I think it was $100 or $2 million to the CRA in order to increase their bandwidth. So we have to be careful. We have to prove intent from the beginning, have it documented, and know what we're claiming.
So I love that. I love the rebate conversation. What I was actually referring to there was the first-time home buyer rebate on the land transfer tax for first-time buyers, or there's also municipal land transfer tax for Toronto. Is there a possibility of them clawing that back? Because it gets applied at the time of closing. Have you seen or heard of anything like that? Or that might be one of the ones that slipped through there?
No, the reason why that wouldn't come back is because in order to get that criteria, you need to be a first-time home buyer. That has nothing to do with intent. So whether you're first or you're second is very easy. It's cut in stone. So no, we haven't seen those land transfer rebates get sent back. Now, talking about rebates a little bit here is we just had a client that the speculation tax that came in, what was it, 2017. And we had a person from the UK. He moved to Canada. He's working for a big company here in Canada. He bought a condo and he had to pay the speculation tax. It was about $130,000 in speculation tax that he had to pay. Ooh. And we are helping him with the rebate on that. And because he became a principal, he got his PRE, so he got his permanent establishment, and he has been working over a year. So there's a couple of criteria to get back that speculation tax. He's in 2 of the buckets. And we did that application back in January. Now, mind you, COVID was obviously extraordinary. He still hasn't seen his money yet in October. And the ministry keeps on coming back and saying, yes, we have it. It's with manager approval. We've heard that for the last 3 months now. I don't think they're too excited about refunding the speculation tax anytime soon. Why? Because Ontario is not generating much revenue because of COVID. Everything's on deferral. So that's just a little bit of a segue. But that speculation tax is definitely real and it does apply. Interesting.
Okay. So as we're kind of talking about speculation or the non-residence tax, that I guess there's different words for it, but that's what we're talking about in 2017. So as we're talking about out of country, before we kind of move on, the primary residence exemption, this applies just within Canada, or if you have residents or primary residents outside of Canada as well. How does that kind of work?
So your principal residence exemption or your principal residence can be worldwide. It does not need to be in Canada. The key is that you need to be a resident for tax purposes in Canada in order, because then you're filing your personal tax return. And no, it can be anywhere in Canada. We've had clients that had one in Italy. Their principal residence was in Italy. They rented a house in Toronto. They sold the Italy house. We made the claim. Very common with people moving to the States temporarily. They leave here, they buy something in the States, they're there for 3 or 4 years, they move back to Canada, and we claim the principal residence if they stayed a resident for tax purposes.
Got it.
So no, it is worldwide.
Okay. And one of the big trends is right now people buying up these Muskoka cottages, and there's big money there. And so do you see any changes? It's not technically an investment property, but in many ways it's treated as such. So do you see cottage taxes coming into play, or how do you see that kind of panning out?
Well, what we've seen with our clients is people phoning us now a lot more about them, because the increase in value has been significant over the last 2 years, and particularly through COVID. And, we've seen plans where you have children own it. It may not be possible in all cases or circumstances. But, I suppose it's possible that they could try to make cottages, which would affect the 1%, at a higher inclusion rate. I'm not sure how they would really do that, but that could always happen in some case. I wouldn't put it past the CRA, especially when they're trying to earn money. But really, the tax planning around cottages is, trying to limit your land transfer tax if you are doing planning between children and parents, because there is a play in there where you can have your kids own it and claim it's their principal residence. However, it does trigger other circumstances. And the key is to keep all your receipts. I mentioned it before. You want to keep your receipts so you can increase your cost base in order to limit your capital gain. Some people forget that husband and wife have to share the principal residence exemption. Husband doesn't get one, wife doesn't get another one. It's a family unit. And that's kind of the thought around cottages.
Yeah. So every time we have conversations, my favorite part of all of this is that you get, and we're getting different scenarios here, but you get so excited. It always lightens my day when I say, hey man, this is a scenario. What are your thoughts? And that conversation can be very fluid and definitely applicable to me and to my clients. So if other people have specific questions for the scenarios that they're in, what's the best way that they can get a hold of you or your firm to talk a little bit more about tax planning or different accounting strategies?
Yeah. So our phone number is 905-678-2740. And we have a website, HS Partners LLP. And we're located right beside Centennial Park at the Orbiter Drive. And you can drop us an email. Our email is on the website under our team. You can find my extension and my email there. And we're happy to have a chat.
Fantastic. Thanks again, Leo. It's been great catching up, brother, and we'll talk again soon.
Okay. Bye for now.